Welcome to another video of financial indicators, video number 10 by Fahad M. Gohar. Today's subject will be the Manufacturing Purchasing Managers Index, PMI. PMI, of course, it's a key financial indicators that reflect the economic health of the manufacturing sector. Of course, it derives from monthly survey of purchasing managers across the industry. So what you do actually, you survey many, big company managers, and then out of that idea, you consolidate your data and you will have an overview of the purchasing managers, and how they are interacting in the market. Of course, it provides insight into the factors like production, new orders, inventory levels, supplier delivery time, and employment. Now, let's look at the levels, or the categorization of PMI. PMI start from, of course, 0 and it goes all the way to 100. If the PMI actually equal to 50, what does it mean? Reflects no changes, of course, which indicates stable manufacturing environment. But how about if it is below 50? What does it mean? It suggests, of course, contraction, pointing to an economic slowdown. How about if it is above 50? What does it mean? Indicate, of course, expansion in manufacturing activities, which signal an economic growth. So we always want it to be at the 50, everything is stable, but we want it to be the PMI above 50, which means the managers are purchasing a lot of equipment for their facilities, for their factories, for their industry, which of course will boost the economy and will make the economy goes much higher, because now when managers purchasing and the orders are very high for raw materials and all that stuff, it means the economy is doing well. So now let's see what's the effect of the high PMI when it is above 50 for several factors within the economic industry. Let's go for the market confidence first, and that's very important. A high PMI, of course, generally boosts market confidence, signaling robust manufacturing growth. So market confidence goes high. How about the interest rate? What's going to happen to it? Of course, central bank closely monitor the PMI when setting monetary policy, and a consistently high PMI may push central bank to do what? To consider raising the interest rate to prevent what? Prevent inflation. And we already discussed that before in several videos. When everything it's getting close to be inflated and inflation is creeping up, the central bank will interfere, raise the interest rate, so to dry up the market of funds, and that will lower the inflation. Now, how about the bonds? What will happen to the bond? Remember, if it is above 50, means everything is going up, inflation is going up, so the Reserve Bank will increase the interest rate to slow down that inflation. But when they do that, what happened to it? The price of the bond will actually fall. When PMI is high, bond yield tend to rise. Why? Because since the potential for increased inflation may reduce bond prices, because when the interest rate is high, means we are issuing a new bond with a higher interest rate. The new bond, what will gonna happen to the older bond? The older bond will lose their yield because they're not gonna be in favor, to be purchased. So the bond yield will go down because now the people with the new interest rate, it's high, they will be buying the newer bond with a higher yield. So most of the old bond will be not favorable. Okay, now how about the currency value? What's going to happen to it? Of course, high PMI value often strengthen the domestic currency because it indicates robust economy and high demand for goods, which of course push up prices. which will lead to, of course, inflation and could force central bank again to raise interest rate to keep inflation in check. But the currency value goes up here. How about the government debt? A strong PMI, of course, what's going to happen? It will improve the country fiscal health by increased tax revenue from booming corporate earning. This may lower, of course, government, borrowing needs and reduce the government debt. So government debt will go down. Okay. Now, how about the corporate earning? Of course, we know that right away. Companies in the manufacturing sectors, closely track PMI to gauge production demand. A high PMI suggests strong sell, which will lead to a higher corporate earning. So the corporate earning will go up. Okay. And now, what about the stocks? What's going to happen to the stocks prices? Okay. A high PMI usually boosts stock prices because now companies are, doing well, especially for manufacturing and industry company, as it signal higher production sales and profit and revenue. So the stock prices will go up. Now let's see what's going to happen when we have a low PMI, how it will affect those aspects we have just discussed in the previous slide. Let's go for the market confidence first. Of course, as a low PMI might worry investors about economic health, which will lead to market sell-off. So the market confidence will go down. How about the interest rate? Of course, a low PMI might prompt interest rate cuts to stimulate activity because the government wants to grease up the market or the central bank, so they will pump more money by lowering the interest rate, and so to increase the borrowing activity of the consumers and the manufacturer. About the currency value, what's going to happen to it? Of course, a low PMI can weaken the currency, reflecting economic vulnerability, which indicate weak demand, and that will ease, of course, inflationary pressure and the possibility of lower interest rate, but the currency value will lose its, attractiveness. About the government debt? Of course, a low PMI can pressure government finances, which increase the need for borrowing and potentially raising government debt again, because now the PMI is low. The fund that comes to the government as taxes is low, so they have to start borrowing. So when they start borrowing the government, then their debt goes higher. Now, how about the bond? What will happen to the bond? Bond prices, of course, rise here. Why? Because a low PMI can lead to a lower yield. Okay, as investors, of course, move towards the safety of a bond, expecting slower economic growth and potentially lower interest rate. Okay, so the bond prices will rise because now people see that the PMI is low, they're scared. What they're gonna do? Put their money in the bond, so the bond prices will go higher. That's logic. Now, how about the corporate earning? Of course, a low PMI implies reduced demand, which potentially, of course, hurts profitability of the company. So the corporate earning will go down. How about the stocks? What's going to happen to it? Of course, the price of the stocks here will fall because a decline PMI can hurt stock prices due to what? Concern about declining economic activities and earning. So the stock prices will go down. So I hope both slides give you an idea about how the PMI being above 50 or below 50 and how it affects other aspects within our economy. Now, this is here, you can see an overview side by side, so you can compare if you like to do that. Now, let's see this chart here. This chart here, effect of manufacturing PMI on various economic aspects. market confidence. We just talked about all those, interest rate, bond, currency, etc., etc. Like for example, here the economic indicators, you can see it, not the one I told you, from 0 to 50. Okay, and here this is the relative scale for the economic indicators. Here the manufacturing PMI. Okay, and you can see how it affects. For example, let's look for the interest rate. Interest rate will be the one is square, which will be at the top of this one here. Okay, stock prices, same thing. Government debt, same thing. So it's just, this is an overview of what we have just discussed. Now I hope this will give you small idea or information about the manufacturing PMI and how you can use it to monitor the market, and then accordingly you can make your action how to invest. See you in the next video.